Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. For the next hour, Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
That would make me Guy Allard. How's everyone doing this fine Saturday?
Well, if you don't have a lot of nerve, you can't stand the stock market right now. I promise you that.
I tell you, the stock market has swung 700 points in a day, which is about 3% if you're using the Dow, up and down. Everybody seems, boy, we got right into it. We didn't get to visit it all a little bit or talk about anything. But, everyone's got their own opinion of why it is. And if you really look, they're thinking it was the China deal. But if it was China, it would be a broad sell-off. And it really wasn't a broad sell-off. If you look at the sectors that are really dragging the markets down right now, you've got oil. OPEC this week talked about cutting back production. Now, whether they all stick to it is another story, right? Because they try to cheat and they try to get something. Whether Russia complies, right? There's some thoughts that Russia's also getting in and they're going to restrict oil. And banking. The banking sector was down big, and also construction. Banking, because the feds are doing the rate deal, right? So it wasn't really, tech stocks did pretty decent this week. So, if it was really China, you would think it would be either a broad sell-off, right? Everyone just getting scared, wanting to get out, or tech, because that's where a lot of the tech goes. What do you think?
I think after 9 years up in a row that they're looking for an excuse anyway.
You think it's running out of breath?
Yeah, it's just run out of breath. It's done. Corrections are normal, necessary. They'll cool down an overheated market. They just can't go up. Nothing goes up forever. So when you have any kind of news, I mean, what the sell-off the other day was Trump said he's the tariff man.
I'm tariff man. Yes, I remember.
Is that a song?
We're going to make one out of it.
And so, remember, it went up last week because he said, I'll cut a deal with him. We're going to hold off tariffs for
It was a great deal,
days.
Wonderful deal.
Yeah.
That's right.
He's going to definitely do it. Then this week he said, no, we're still going to live with the tariffs. And then they arrest I think he's Mr. Wang, one of the big CFOs, I believe, of China, one of the big Chinese companies.
Well, how about the dude in Japan from Nissan with, there's no habeas corpus there, right? So, they're just holding them, and they keep coming up with new charges, but, nothing really sticking.
It wasn't us that arrested the Chinese CFO. It was Canada at our request.
It was, and actually that gal is the founder's daughter or something. Oh yeah. But they were also saying that was it something that Donald Trump did, because it was the timing was the same as the night that he had dinner at the G20 or whatever but actually that was put in effect by another agency well before.
See, I don't understand it's supposedly for breaking some and trading with Iran or something.
That's right.
Like that.
Through a third party, through a third company.
Right. But I thought that was just these countries, hey, we're going to agree not to do this to Iran. But how do you get arrested for that? I don't know. Doesn't make sense to me, but I don't know.
And who enforces those sanctions, right?
I'm like,
as far as criminally.
Because we know all these other countries break those things all the time, right? So now we can arrest them? I just don't know. I don't understand how it works.
I've been hearing commercials on TV about all these new agents that the IRS is adding on to get people for taxes. I think, is that true, or is that just some marketing stuff?
Well, the Chinese government has said now we're going to arrest some U.S. Executives. They're based in China. I'm like, uh-oh.
If I was a U.S. executive in China,
I'd be
planning a long trip home. Hey, real quick before we get too far away from the market correction. Because the market's pulling back, as Victor so aptly said, it's been a 9-year bull market. It's due. Just because it has a pullback or correction does not mean that it's an automatic, the country goes into recession. Those two seem to be synonymous, but they're not. We can have a correction and a pullback where the economy doesn't go into a recession, because actually, if you look at all the figures and all the stats right now, the market's ignoring the positive stuff. Where we still have high growth, but it's not as high as it was at the beginning of the year, right? We're still, 2.5? It was at 4, so is it coming down? Yeah, but, 2.5 is pretty good.
Have you ever studied the beginning of bear markets? It's usually when everything looks great.
Yeah. Well, you never know when it's coming. The catalyst. You don't know what causes
it. In 2000, tech stocks were going up to 70, 80% a year.
Yes.
Just assuming, oh my gosh, this will never end, and all of a sudden, boom.
What was Amazon's P? 485? Was it higher than that?
Oh, they didn't even have it. Most of those big tech companies in 2000 didn't even have a PE. It was because they were negative. They were losing money. Yahoo, all that.
I mean, I thought it was crazy numbers.
Yeah. So there is no way to tell. Who knows? I have no idea what it is. I'll pick apart the market a little bit by sectors. Some sectors are actually doing still pretty well.
Right.
It's more like a sell-off, and basically the market's about even for the year, it's going between down and up 1% back and forth the last few weeks.
That's right.
So basically just stop going up, which, some people say it's taking a breath to keep going up. So other people say this is the beginning of the end. There's no way to know, but it's more a sell-off like in 2000. In 2000, it was mostly tech stocks, right? And tech stocks, the dot-com bubble. And tech stocks that were going up so crazy went down like 70, 80%. It was bad.
It's a big deal.
The other stocks went down 40 or 50. But this year, healthcare is up 14%. Now, I'm doing it all since right before the market closed for George Bush's.
That's because they charge so damn much. Holy cow! Healthcare, medicine.
Every single place that I see under construction, when I go to a main road, it has to be a hospital or one of those emergency clinics or something.
I won't mention any names, but I know someone close that went to the hospital. All that person had was blood work and was in the emergency room for about 2 hours till I went there and picked them up and took them home. The bill was $11,000, and they didn't do anything at all. It's crazy.
What are you saying? That's not fair?
Yeah.
$11,000. That's it. Hey, $5,500 an hour. I think that's normal. Right?
It was crazy.
I've got to do an inpatient procedure, and I'm afraid because the last time I did one, I was there like 3 hours. It was $16,000 just the hospital part, just that part, not the doctors or anything else.
That's crazy. Isn't
I was
it?
like, yeah. So, every time I want to be mad at insurance companies for killing me on rates, I spent $60,000 between insurance premiums and co-pays and all that stuff for me and all my minions of kids, right? But I'm like, how can a person afford that if they're just a normal person? I mean, if they're making $80,000 a year, how you can afford $60,000 after taxes just to go to your health needs? But healthcare keeps going up.
As we talk about, the swings and the volatility of the market, and we can get into it more later, but as long as your portfolio is balanced correctly, you hear us talk about our cornerstone is the 3 buckets: liquidity, make sure your income's taken care of through retirement, and of course the market piece. Also, you hear us numerous times talk about the rule of 100. You subtract your age from 100, and that's the percentage, the max that you should have at risk. The easier way to interpret that is your age is the percent that you should have safe. Why is that? Well, it's because of market volatility, and because as we get older, we have less time to recoup a market pullback or a crash. And how much time does it take to recoup? And I just went through this with a client from Highland Park earlier this week, so I've got the numbers fresh. In 2000, when the tech bubble that you were talking about, Victor, hit, it took 7 years. If you had $500,000 in the account and it went down to $400,000 let's say you had $1 million, it went down to $400,000, it took 7 years for it to get back. And that's if you paid no fees. That's not shouldering the burden of fees. In 2009, same thing. It took about 6 years. So what happens with the market if you look at it? The market goes up slowly. When it corrects and comes down, it comes down fast. It comes down within a year, right? 6 months or so usually, and the correction is done and it's hit and it's devastating. But it takes you 6 or 7 years to grow it back under normal circumstances, and history doesn't always repeat itself when it comes to the stock market. So that's what you're looking at. And if you're in retirement or close to retirement, do you want to wait 7 years on your money and really make nothing if you're not paying fees?
And the problem is if you're taking money to live on,
it's worse.
Expenses out of that money, it's called the death spiral. You can't get out of it. You take a big loss at the beginning of retirement, and you need a certain amount of income. If it's 3% or 5% of whatever your portfolio value is, it cannot recover. It cannot recover. Think about it. You got $1 million, goes down to 500. You need $50,000 a year. It's down to $450 in 1 year.
Yep.
Market makes 10% every year till the end of time, which it won't. You still never break even.
No.
You'll never get above 500 again. And so what happens is if you have another one of those years just even, not even lost or gained, now you're down to 400 something. It's impossible unless you have an account that you don't take anything out of, you don't need. So when we get closer to retirement, we're going to need part of our funds to help pay our bills. And so that's why you have to get a smaller and smaller footprint in anything risky. The market is probably the best thing that you would do that's risky. But you can see a slowdown all over. Look at your neighborhood. Anywhere in Dallas here, are there more for sale signs than there were last year? Just look around. You'll see some of the signs. Remember, if you have any financial questions, don't hesitate to call us at 972-715-2424. You can always go to our website, ilovemyretirement.com. Stay with us, folks. We have a break coming up. You're listening to the Common Sense Investing Show on News Radio 1080, KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is always based on facts instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the Common Sense Investing Show. Before the break, we were just discussing this crazy market and what it's doing today.
That's
this
not
week.
what we were discussing. Oh, I thought you said during the break.
No, before the break.
Okay.
Nobody needs to know what we're talking about during the break.
I thought you were going to share that with the audience.
Remember, the market's gone up. It's actually like 9.5 years in a row, whatever. Nothing goes up forever. Look at, like I said, what's been driving a lot of this market for a lot of years. Real estate has. It really has. Look at it starting to turn.
Interest rates were so low.
Yeah, interest rates go up. That always slows down
Real estate
loans,
right?
Loans, everything else. So it's all starting. I mean, 2 years ago, you couldn't find a house in my neighborhood for sale. Now there's a bunch of them, and they're taking a lot longer to sell. And
it also provides competition for the dollar for the market, right?
Mm-hmm.
If you can get decent rates, you may get.
I think you sold your house at the peak of the peak of the peak. That's like a bidding war in one weekend. I'm like, lucky.
It was the best deal ever for me. My whole life. It would probably never happen again.
I try to sell it, and they're trying to knock off everything into the sun. Well, I'll give you about $200,000 below appraisal. I'm like, how about I strangle you?
Yeah.
But so you got to be careful. I know a lot of, like I said, people live this stuff. I don't have an emotional attachment to the stock market, to the real estate market, to anything. Because I've seen stuff go up and down so much that I'm like, I'm just leery of all of it. And if you have a proper plan in place, it never affects you as much. Remember we talked about the first segment, the rule of 100s or whatever. Just if you're 80 years old and you got 80% safe, you're not worrying about the stock market as much.
That 20%.
It's the people that got 80% at risk when you're 80 years old because they just knew the market was going to continue or whatever. If you follow the tried and true rules, remember, the 4% rule doesn't work as far as withdrawing 4%. You get about 3% now. But if you follow those kind of rules, market volatility doesn't affect you as much.
There's a reason there are rules.
Oh, yeah. But I'm telling you, you don't know how. You ready, Victor? You don't understand. It's a paradigm shift. And I believe for the next 5 years, I'll go, where did you get that from? Well, I heard it from somebody very smart, much smarter than you, actually. I'm like, well, thank you for the compliment. I go, it's usually a talking head. Remember, people have remember that confirmation bias.
Oh, yeah.
They do it with politics. They do it with social things. They do it with the market. If they're thinking a certain way and somebody comes on television, now, you don't understand. They try to sell us these spots on these televisions to be guests on these shows, on Fox and everything else. For years they've been doing this, asking us to be on here, right? So there's just another person kind of like us. But they heard them say one certain thing that they kind of agreed with, and that confirmed it. I'm going 100% stocks till I die, or I'm going to be 100% real estate because the real estate will never go down. They're not making more land, right? And it doesn't matter. There's stuff still crashing.
Just think about how polarized politics are right now. Whether you're Democrat or whether you're Republican, there's almost no common ground. When you can find PhDs, Nobel Prize winners in economics, I mean, very sharp, cerebral, intelligent people, all they've done their whole life, they've been prodigies of math and all of that. And you can find one that'll tell you the market's going to correct, you better not do it, you should short the market. You're going to find one, absolutely not, it's taking a pause, like you said earlier, a breath. You need to stay in the market. So what do you do when it's not black and white and it's not cut and dry? You've got a plan.
Stay with the rules.
Stay with the rules. You allocate it properly as we get older. Here's what you do, and we were talking about this last weekend in Phoenix. We help people de-risk their portfolio. When you're younger, what do you live off of? You live off of human capital. What's human capital? It's you. It's you working. You're going to work every day. You're human capital. When you're retired, that goes away. And now you're working off of financial capital, what you've been able to save. And Social Security, that's it, baby. I mean, that's all you've got to live on. So you've got to plan it properly so that when you're getting close and into retirement, that financial capital is there to support you.
Like I said, if you follow the rules, it's just hard. It's hard because we're humans. We are emotional. You're not supposed to be emotional about your money. Try to find somebody that's not emotional about their money. And so what we'll do is we all take our own biases. We bring our own, baggage with us. No matter what we do, we'll do it in finance. We'll do it in social things, whatever. And the problem is with that, if you're wrong, you're screwed. And so you've got to be careful. I'm not putting everything in, because I can give you stories all day long about people that have lost it all with rental properties.
Yeah.
Like they bought a bunch of them in 2006, 7, 8.
And ones that have done real well, too, right?
Exactly. Some that have done fantastic. Oh, my gosh, I make 25% a year on the capital.
Guys making 7 figures off their stuff.
Yeah. So you can find that anywhere. But usually it's like I said, it's just like anything else. The people that put the most work and effort into it. I just don't believe in a lot of these passive income streams. Remember all these people saying, let me show you how to do this. In 15 minutes a day, you can make $40 million a year.
Retire with $10,000.
Just buy my system here.
Retire with $10,000, have $500,000. If you're not sure where you are, it's real easy for us, and there's never an obligation. We enjoy doing it. Let us give you a quote. Let's figure out what you think you're going to need in retirement. Take a look at where you are right now. We can run the software, and we can give you a quote. We can tell you pretty accurately how far that money will last at a modest inflation rate. And if that's something you're interested in, if you're not sure, call us, 972-715-2424, and we'll give you a quote.
I got 2 people this week called me and said, here's what I'm planning on doing. I want to do this and that. What do you think? Each thing did not work.
Oh, really?
Not even close. What they're doing is they were taking 2 raw of numbers, and they're saying they could reduce some of their expenses.
Yeah.
I'll finish it when we return from the break.
Okay.
But don't hesitate to call us. We'll be more than happy to go over any of your financial questions or take advantage of our no-cost, no-obligation portfolio review, Social Security Optimizer, or whatever else you might like. 972-715-2424, or go to ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by 2 of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the Common Sense Investing Show.
Hey, before we went to break, you were talking about a client that brought a couple things to you, and you were working your magic, and neither one of them worked. What was that about?
Well, a lot of times people will do is they'll have some numbers.
Right.
And they're saying, okay, here's what I'm short a month. Okay, I think I can get it this way. I'm going to do a reverse mortgage. I'm going to do this or that, whatever. And I run the numbers. And most of them don't work. People forget certain things. They'll forget what their the Medicare cost is going to cost, their copays on Medicare, or they need a supplement plan, forget that, or they didn't factor inflation.
Oh, yeah.
In other words, I had a person that called us that retired like 15, 20 years ago. Now they're completely broke because they never factored inflation. They just thought the bills were always going to be $3,000 a month or whatever that number was, right?
I was telling a guy the other day this week that my wife and I bought a brand new Chevy Suburban with a diesel, which was the most expensive version, in '89 for $19,500.
Oh,
you can try to do that now.
Oh, no.
It won't happen.
I think my dad in the 60s, like I said, a brand new Cadillac or Lincoln was like $7,000.
Corvettes in the mid-'60s were $7,000.
We bought my mom a Carmen Ghia, a brand new Carmen Ghia, and that was a really cool little sports car, right?
Day, yeah.
My uncle wrecked it the first day she owned it, totaled it.
Really?
But I think it was like $2,000 or $3,000 or something. That was like
man.
a real nice
those were made out of real metal, too. They didn't have plastic bumpers and stuff on them.
No, they didn't have all that stuff. So
anyway.
Everything goes up. I mean, You think about, what did your parents pay for water bill?
Yeah.
If anything, right? Oh, $5 a month, $10 a month, anything like electric bill. Never heard of a $100 electric bill when you're a kid, you know? So all of these things you have to factor in. Who would have ever thought that you'd be paying hundreds, even thousands of dollars for a health insurance? Who'd have ever thought that? They used to have plans that had no deductible, no nothing when you work for a decent-sized company, and they didn't take anything out of your check. Even if you had to pay for it yourself, it was like $80 a month for your whole family.
Yep.
So you have to factor in all those things. Also, what people do is they cut it so close. They're like, well, I think I can knock off $500 or something like that. I go, when you do a plan, you want to have at least $500 or $600 over, because when you start factoring inflation, those are going to even out in 7 or 8 years. And now where are you going to cut? You can't cut another $500 off 7 or 8 years from now. It just doesn't work that way. And then another $500 7 or 8 years from that.
Was this a solvable puzzle?
It's solvable. Both of the ones that came in this are solvable. But there's one thing that nobody wants to hear.
Oh, yeah.
You got to work longer.
Or cut your budget. No one wants to cut the
more.
budget. Yeah.
But that's what our job is. Our job is to tell you the things, the hard things. Believe me, most of the people in this business tell you what you want to hear. Because it's a lot easier to procure new business than to tell you what you want to hear. And
on a side note, they'll run projections for you at 8, 9, 10% a year, even 7 or 8% a year. The market's done 4.97 through the end of last year, starting in 2000, with no fees and dividends.
And the way this year is ending,
it'll be
you'll be back at like 4.5% for 19 years.
That's right.
So remember, it took 9 up years in a row to get us to 4.97. That's what people don't realize.
Say that again.
Yeah, 9 years, up years in a row to get us to the high of making under 5% for the last 18 years.
Think about that.
But that's why I remember paying these ridiculous fees like on variable annuities, 4 or 5% a year. It only made 4 or 5. It's ridiculous. You can't pay high fees and ever work out ever. Anybody tells you they shouldn't. Now, low cost annuities are fine. Okay, but you cannot stay with anything high cost, and that's a high cost managed program or a high cost annuity.
And there's a couple low cost variables, right?
Right. There's the biggest threats I see to retirement aren't necessarily the market volatility we're experiencing right now. It's healthcare, inflation, and no retirement plan, or a plan based on averages that don't come to fruition.
Right.
Those are the things you got to really be careful for. We had the weird thing where the 10-year yield curve was about 2.8 when the 2 years 2.3. A flattening of the yield curve is not great for the economy. Because who's going to buy a 10-year? Who wants to buy a 10-year one? Now, knowing that I've got more risk in that 10-year one, and it pays barely more than the 2-year. Nobody would, right? Well, what happens when nobody quits buying stuff? Because the price has to.
10-year got to about 3 1/4, and you notice money started flooding in, and it knocked it right back down to 2.8, 2.9. Traditionally, when the 10-year got to about 3 1/4, got to 3.24 this time, it also signals some sort of recession or pullback.
You got to be real careful with these things. Remember, it should be if I risk my money for longer, I should make more interest.
Right.
And right now it is, but that's pretty flat. and we've experienced this over the last several years. Sometimes you have a negative yield curve. Like, who the hell would buy anything long term if you can get more short term?
1 year's paying more than the 2 year. Go figure.
Who would do that, right? Well, we'll go over that. Just call us if you have any financial questions. We're here to help. 972-715-2424. You always go to our website, ilovemyretirement.com.
And we'll have new videos coming out soon.
New videos soon on the website. You also white papers. You can do anything you want on there. Stay with us, folks. We have a break coming up. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, the home of plain-spoken, no-nonsense answers to your financial questions.
Welcome back to the show. We talked right before the break. We're talking about the biggest threats to retirement or people's longevity. It's not necessarily the volatility of the market.
Unaccounted for expenses, inflation.
Right. A lot of expenses people don't realize. Some things will go down when you're in retirement. Some things will go up. People's discretionary spending a lot of times goes up. They'll think it doesn't, but think about it. During this entire week, I've been working a lot of hours. I haven't bought one thing at one store. Right? On the weekends, Amazon.com is lighting up my iPad, right? I think I need that. There's grabagun.com. I think I need that. There's little stuff like that happens. When you have more time to do that kind of thing, you might spend more money.
You can send those email people unsubscribe and get you off that temptation list.
I've done that before. They seem to keep coming back.
They send you more.
Yeah,
I know.
More. I don't know what's going on.
I know.
But biggest threats, this healthcare thing, you got to remember Medicare. Let me retrace it for a second. Social Security is going to go broke in like so many years unless they change things. You've heard that, right? Like 20 years from now or something.
Yep.
Right? Medicare is in way worse shape. Medicare is going to need a lot.
Good news is the government can always print more money, right?
Yep. They're going to keep that's got to come from somewhere. Does that mean if you have more means when you're probably going to pay more for your Medicare Part B and all? Probably.
Yeah.
You got to at least have a part of your income for that particular thing. They're going to raise it. Inflation is something we haven't seen really high inflation for a long time.
No.
But most people don't plan for even 2 or 3%. 2 or 3% inflation, your expenses can double in like 20 years, 25 years.
And that's a big deal when you're on fixed income.
When you got $5,000 a month in bills, and you've done this plan for $5,000, what happens when your bills are $10,000? You didn't go in. You're not in anything new, a better home. You didn't do anything. It's just that's what things cost more.
I mentioned this in an early segment, but if you want us to run a quote for you, it's real easy. It's no obligation. We do it all the time. Figure out what type of budget you're going to need in retirement. And I always talk about, not the penthouse, not beans and bologna, but where you're comfortable. And we'll subtract what income you've got coming in. Social Security, pensions, see what the number is, the bridge, the gap you have to bridge. And we can tell you within a good degree of certainty when you'll run out of money. I had a client in this week. I won't mention any names. He's selling a business building, and we were trying to get the numbers to work. And we spent a lot of time. We adjusted his budget. We adjusted whether you lease, whether you sell, to just the income columns. And as many times as I've done this analysis for people, I was shocked at how much the difference made of $250 a month. It was amazing. With his numbers, which are average numbers, we got it to the point where the income was almost there to meet the expenses, and he'd have like $50,000 left out of all of his money at age 100, which, at age 100, right? But we adjusted the budget one more time by $250 a month. I kid you not. And now all of a sudden he had like $110,000, and just because of the way he grew and the way the drawdown, or if you want to call it the burn rate, was. So if you don't have an idea, it's amazing how empowering just the knowledge can be. And we're more than happy to run the quotes for you. I'd love to get a chance to meet some of our listeners. If that's of interest to you, the number is 972-715-2424. Give us a call.
A guy and I have been both doing this for over 30 years each. And like I said, we'll tell you the hard question. We'll tell you the hard answers. We're going to give you the exact stuff. I don't know how many times we'll have either clients or their former or current advisors. They have some whack-a-mamie plan based on, they'll say, well, this is a conservative plan. You're only going to make 8% a year. Well, obviously, we're going to do better than that, but 8% a year is what they'll use, or 7
We'll use the low number.
Yeah. They're completely disregarding the last 20 years, but they do it all the time. And they're also ignoring the sequence of returns risk, because nothing just stays one level and goes up. Because think about it. If it went up 6% every year, you could take out 5% and never touch your principal, right?
Ever.
That does not work. Anybody thinks it works don't understand math.
Right.
Because the market does not go up in a straight line. So the average means nothing.
Now, if you made 6% every year in a fixed income, and a bond, and a fixed
CD.
annuity, and a CD, it would work.
That's right.
But the sequence of returns risk
you can't have a fluctuating principal ever.
That's
the principal can never fluctuate. And that's why we have pounded and pounded into everybody that anything that's going to pay at least your hard expenses can't be based on a fluctuating principal. Because it will never work. Even the 4% rule that we've been using now since like 1990. Right. Everybody's been using the 4% rule. In other words, take out 4% of your money a year, increase it for inflation every year. It quit working.
They want to lower that number. What, 2.6 or something?
2.8.
Silly number.
Use 4%. It's supposed to give you your retirement a 30-year chance of not running out of money. For 30 years, you shouldn't run out of money. Problem is, it ran out in like 18. 16 if you just got 1% less than the market returns, which the average person got 2% less.
Yeah.
So what would that go by? 14 years? Well, I'm telling you, we're living a lot longer. So in 14 years, if you're tired of 60, you're only 74. Well, that's a lot of living left to be broke. And so you've got to be really, really careful. And that's why you got to have someone like an advisor that offers every kind of solution, not just one. If they just offer an annuity solution or just a life insurance solution, trust me, the answer to every problem you have is going to be annuity or life insurance. Same thing if I only offer a managed program, because the annuities are the devil's work. That's Satan reborn. Well, every single solution is going to be this managed program, regardless of how it's actually done. Like all the commercials I hear about these great ones hating annuities on, look at their real returns. See if you can find it. It's not good.
Oh, don't get me
I'm
started.
Not tell you. No,
it took me a long time to figure that puzzle.
It's not a great return. So and if you look deeply when you read some of the material, they'll say you can never take out more than 3 or 4% ever.
Remind me when we get back from break to talk about a real quick life insurance story.
Okay. Are you sure you want to talk about life insurance?
Yeah, it's appropriate at times.
All right. We got a break coming up. Remember, if you have any financial questions, like to talk to us, we'd love to meet you. 972-715-2424. Again, 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
That's right, Guy's old and I'm experienced, right? No?
Something like that.
We're about the same age, so I'm just only teasing. You were going to talk about something about life insurance.
Yeah, I was going to mention, we do, our clients dictate what direction we go. We try to figure out what they're trying to do, what they want to accomplish. And we kind of go through and audit what they have and make sure our buzzwords are effective and efficient. And I had a great guy come in last week and sat down, went through everything, and he had a lot. The person that he was involved with prior put him in a lot of life insurance, and it has its value. And his main goal for that was so that if anything happened to him, that his wife was taken care of. And I'm talking a lot of life insurance. The company he had, we won't mention, was a great company. They just were expensive. We were able to do this after reviewing everything and spending time. I put two special teams together, one in Phoenix, one here in Frisco, and reviewed it and went through the numbers. And we were able to do one of a couple of things. We could either keep the same amount of coverage for him and cut his premiums in half, or we could double the benefit for his wife and keep the premiums the same. This particular gentleman wanted more for his wife, so he kept it the same. But where I'm going with this, if you've got some life insurance policies, we talk about running quotes for you to make sure you don't run out of money and see what the gap is income-wise you need to make sure that you've got a guaranteed retirement instead of a non-guaranteed. Happy to do that for you. But also keep in mind, part of that, if you've got some life insurance policies, you can be with some really good companies that just might be expensive. And it's real easy for us to kind of go through the numbers. And if you've got a good policy and you've got great benefits, we'll tell you that. As Victor and I have shared many times on this show, a lot of folks that have pensions with companies that have the old actuarial tables or even the teacher union stuff, you just can't beat that. And we'll tell them, you're in really good shape. Don't take the lump sum. Everyone else is trying to get them to take the lump sum so they can invest the money. And we'll say, no, you've got a good deal. Keep that. Well, we do that all the time. And when we do that, do you know what our fee is? Our fee is if you hear someone say, man, I wish I knew someone good that can handle our funds, you refer us to them. But if you're not sure on your life insurance, if you're not sure about how long your money will last, call us. We'll be happy to give you a quote. Again, that number is 972-715-2424.
Remember, the thing with insurance is for buy-sell agreements, for anything like that, especially a lot of company owners, you almost have to have it.
Right.
You don't want your partner marrying a mail-order bride from Kazakhstan, and then she takes over your company.
It's like if something happened to you, you get hit by a car, I'll be working for your wife. That can't happen, can it?
Got to have those kind of things in place. But it runs contrary to what you might think. A lot of people say, well, I've had this policy so long, so it's going to be way better than a new policy, right?
Right.
Because theoretically, I have a lot shorter lifespan now than I did then.
And you may not be as healthy. There are some
That's
things.
right.
Yeah.
You got to make sure you're healthy enough.
Yeah.
If you're still healthy, that stuff works. But the tables have come out. The longevity has increased so much. It's very rare. We can't improve a policy for the same premium or cut the premium in half, whatever. But also, there's so many innovations in the newer policies.
Long-term care is provided for in a lot nowadays.
You can get up to 20-something thousand a month. Long-term care is a free rider just added to the thing.
It wasn't available a lot of times
It wasn't
before.
available on the old ones. Much more flexibility. Like a lot of the whole life policies are just basically, you got to pay this, blah, blah, blah. Well, what if I want to skip a couple of years? Well, you can do that with the new ones. You still get the long-term care benefit, still get the death benefit, all those kinds of things.
And you don't get canceled.
You don't get canceled right away.
That's right.
So there's all kinds of different ways, and it depends on what you need. Everybody knows for retirement funds, I'm not a big life insurance guy because they'll try to sell it for everything. But for certain things, business owners and all that, you need it.
That's right.
And so might as well get the most bang for the buck. Our number 972-715-2424. I have got to say this thing. We only have a couple minutes in the show, but I keep seeing all these Roth 401ks. The last couple of weeks, I've seen like 3 of them. If you have a choice between a regular 401k and a Roth 401k, remember we've talked about this before, 90% of the time you should take the regular 401k. That runs contrary to what people think, emotionally. Like,
everyone loves tax-free.
Yeah, tax-free, of course.
Tax-free bonds, tax-free Roth.
If you're in the 25% tax bracket during your working years, if you expect when the paycheck stops to still be in 25 or higher tax bracket, not a bad idea. The problem is 90% of the general public, maybe 99, will be in a lower tax bracket because the paycheck stopped.
So
you're
when
just taking money out of accounts.
So when you convert it to a Roth, you're paying more in taxes than when you. Yeah.
That's right. And the numbers are identical. If you ran it to say, okay, I'm going to put regular IRA $1,000 a month, Roth, $700 a month because you got to pay tax on it first. Run those numbers and put the after tax on it. It's exact same to the penny if it's the same tax bracket both. But if you're in a lower tax bracket, you should have never done the Roth. Now, is it okay to do them on top of other accounts? If you make an income below a certain number, sure, absolutely. There's nothing wrong with doing it in addition to. But if you ever have a choice, don't do the other. Now, most of the time also converting to a Roth. The government didn't give you some big windfall landfill, the windfall of money.
I knew where you were going.
They just learned how to get all their taxes, like 30 years worth of taxes up front.
That's right.
It doesn't do you any benefit. Now, let's say you're a person of means. You're in the highest tax bracket now. You're always going to be in the high tax bracket. Roths make a lot of sense in those cases because I do think taxes can go up a lot. I'll just pay the one now. I think this is a decent rate. You protect yourself against future tax increases. Very good for somebody in a high tax bracket now, and no, even in retirement, which is less than 1% of people, no, you're going to be that. So there's different things. Call us if you have any questions about that. 972-715-2424. Again, 972-715-2424. I'm Victor McClure for Guy Allert. We always, always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.